Welcome back to the Graham Stephan Show, and today I want to comment on Dave Ramsey. Now, for those who are unfamiliar with who he is and what he does, he's very anti-credit card, he's anti-debt, and he's one of the original financial influencers before financial influencer was even a thing. Before even an influencer was even a thing. There was Dave Ramsey. Now, in this video, he comments on the current state of the stock market and what to do when your stocks just keep plummeting in value. So I wanted to add on some commentary to this as soon as you hit the like button and subscribe, because I think you'll find it helpful, and I have a lot to say about this. So with that said, let's begin.
He says, I'm 61 years old. I'm hoping to retire soon, but watching my retirement savings go down day after day. The only part not going down is $180,000 sitting in the bank, earning almost zero interest, but not completely eroding away with the stock market. What should I do?
Well, first of all, why is he earning 0% interest on his savings? That makes no sense. In a market like this, even a few months ago, you could easily, worst case, if you're bad at it, get 3.5%. And that's if you're not even trying. If you go and invest in, let's say, short-term treasuries, you get one of the high-yield savings account. I think even Ally Bank is above 4%. There's now like 5% savings accounts and money market funds out there. There's so many options. To get 0%, in my opinion, in today's market is financially irresponsible. It's bad. You know what? Like, the only places that don't pay much, Bank of America, JP Morgan, yeah, sure, your money's safe there. But up to $250,000, it's FDIC insured anyway. So, at least from my perspective, you may as well do it up to the $250,000 per bank.
Let's talk about this retirement savings, because you're telling me that it's, quote, completely eroding away. And that's just not true. The stock market is down, but it's not completely eroding away, and it will come back up.
Oh, I need one of those stickers. Look at the stickers on the computer. Better than I deserve. That's great. Self-employed mentality. All right, that's fine. Debt is still dumb. Hope is still real. I don't know if I want that sticker. I think debt could be good. Some debt can be good. Some debt's stupid. Okay, I'll admit it. Keeping credit card debt. That's stupid. Keeping a mortgage at like 9% interest. You could go either way on that. It's probably bad, okay, if you're not paying it off. I think, though, 30-year mortgage at a low interest rate, great. Really low interest rate on an auto loan. That could make sense. Some debt could be good. Get a credit card. Pay it off in time, in full. That could be great. Get the points. Not all debt is dumb. But I see what he's saying. When you see your retirement savings, especially when you're really close to retirement, and you see the market just plummet 20% like that, I bet it would be nerve-wracking, okay, to see like 20% of all of your life savings is gone. But you have to think about it. Number one, if you're that close to retirement, you shouldn't probably be in all stocks that would go down 20% like that. That's probably bad planning on his end. But number two, usually stuff like that will recover if you're diversified and you hold on long enough. So it's not like it's gone forever. But yeah, in the short term, it's kind of gone.
One of the things you have to understand, and it helped me because I actually got into the research, especially when it comes to investing, but a lot of other things too. We all have a drama queen that lives in our brain that exaggerates everything. And, oh, God!
He went from 0 to 10 real quick right there. From just really calm to, I like his impressions a lot. I think you should do more of them.
The studies have told us now that it takes $3 of gain in an investment to emotionally offset $1 of loss.
That is interesting. That's why I watch Dave Ramsey, okay? Every now and then you're going to learn something you didn't know, even if you disagree with him fundamentally and stuff. You have to admit, that's really interesting. I would tend to agree. We as people tend to fear a loss way more than we do enjoy the gains of something. So that makes sense.
Completely eroding away!
Yeah.
Oh, bull. Okay, it's down maybe 10%. So if you got $1 million now, it's worth $900,000, and next year it'll be worth $1.3 million. Have you ever heard people say this? I lost all my money in the stock market. Mathematically impossible.
Yeah, unless you invested in, what was the one that just went out? Lordstown Motors. Oh, it's crazy. Go and look up the ticker symbol RIDE. Prime example. They came out when all the EV hype was going around, when free money was everywhere. Stock market euphoria was at its peak. I'm talking like 2020, 2021. RIDE comes out. Lordstown Motors goes public. Everyone goes into a frenzy. Like, oh, wow, they're going to be the new Tesla, whatever. Now look at them. The stock went from a peak of $435. It's down to $2.25. And why people or even buying it at this point, beyond me. I think some people are speculating that, hey, maybe someone bails them out and they somehow turn around and, oh, I'm buying a $400 stock for $2.25. And if it just goes to $5, then I double my money. No. Chances are it's a steaming pile of crap that is not worth the risk, but if you were to go all in something like this, yeah, you could lose pretty much 99.99% of your money if you don't diversify.
What people really mean is I lost a bunch of money, I freaked out, I went into hyper drama mode, I pulled my money out at exactly the wrong time while it was down, and then bitched about it for the next decade. That's what we really mean when you say I lost all my money.
You know what's also really interesting? Peter Lynch had something called the Magellan Fund, or the Magellan Fund. I don't know how to pronounce it. It's a fund, okay? Peter Lynch had a fund. That fund outperformed the overall market for like 30 years by a large amount. But guess what? The average investor of that fund lost money. Why is it, you might ask? Well, it's a really simple answer. The reason the average investor lost money in a fund that outperformed the market is because those investors would buy in at the peak, at the euphoria, when it's already outperforming, sell as soon as it comes down, lock in a loss, and then buy back in when they see it's recovered, plus some, and they're basically buying the highs, selling the lows, and then being like, oh, this whole investing thing doesn't work. If instead that same person just dollar cost averaged into the fund over 30 years, they would have made a ton of money.
My son is 5 and I do his hair for him every morning because he's got curly hair. And I have to spray it down with water and he hates that. Today,
I have to do that too.
Do you? To just keep the shine going. Dave, a little drip of water drips from his hair like onto his shirt and he's like, look at me, I've got water all over me.
Dave Ramsey could just use a wax or something like that, keep his head all nice and shiny. You know what's interesting now? I never thought about this, but Kevin O'Leary, very similar to Dave Ramsey in terms of the hair situation. Kevin O'Leary says he often has to put makeup on his head to prevent a shine. Something I never even thought of, but it makes sense when you're on camera like this. You got to put on like a little something to make sure you don't seem too reflective.
We have to do the facts to tell our drama queen to shut up.
Yeah.
We're going to continue to invest. And no, I'm not got $180,000 sitting in the bank wondering why it's not going up, because I know it's not going up.
That ain't doing...
It's not doing squat.
He's tripping. He thinks that money's doing well. That's losing value too right now.
Yeah, you know what? $180,000 is too much money. Now, if he's retired, and that would be 1 year of spending, I could see it, okay? Even 18 months of his spending in cash, if that's $180,000, I could at least wrap my mind around that. But if 180 grand is like 3 years of spending for him, makes sense. Have it at least in treasuries. Have it in something that's making you a little bit of money. Otherwise, you're leaving cash on the table. You're leaving profits on the table. Because right now, you could get a locked in 5% on your money on, let's call it $200,000. That's $10,000 a year, almost $1,000 a month that this person is not getting because they're not doing that.
Every single down year in the stock market's history but one is followed by a record 2-year rise.
Wow.
So if you're out right now, historically, you're stupid.
And that goes to show you, the S&P 500 so far, kind of interesting. Year to date is up 15%. Goes to show you, as long as you just stay invested, stay the course. It's a long-term game. You're not judging your performance like month over month. That's just stupid in my opinion.
Now, Jesse, you said that you're still working. You haven't retired yet, so keep investing.
Yeah,
Now's a great time to buy.
Get the $180,000 invested right now, dude. I don't time the market.
Yeah, I tend to agree with Dave, and if you're nervous about that, just dollar cost average. What that means is that if you have cash on the sidelines, sometimes it can be helpful just to trickle it in a diversified fund or whatever you want to invest in over time. That way, you spread out your investment over a long period, and if it goes down, at least you're not buying it all in at the same time, and if it goes up, you're going to make a little less money, but that's the trade-off.
Every down market, bear market that it holds out as long as this one has held out is followed by a 2-year upturn.
That's good to know.
Except one. Every single one of them.
What was the exception? Do you know?
No, not off the top of my head.
For Dave Ramsey to be so full of facts, he's like, no idea.
Just hang on. When the leaves get green next spring, You gonna be okay?
I agree with that completely, but there is another video I do want to comment on, and that would be this. It is a video of Dave Ramsey absolutely going in on someone who can't afford any of this, which happens to be the title of this video. Just watch.
In November, some land came available, some acreage came available very close to us, and my husband and I bought it. Our home was paid for, but we used an old HELOC that we had there to purchase the land because we didn't have enough cash to buy it outright. So since then, the rate on the HELOC has more than doubled, which means our payment has more than doubled.
Oh, awful. So let me explain what they did, okay? They have a house, and they have a lot of money in the house, but then they find a plot of land. They don't have the money to buy the land because all the money's tied up in the house. So what they do is they borrow against the house. The house turns into basically a credit card where the rate floats. When interest rates are low, their rate is low. When interest rates are high, their rates are high. Well, guess what's happened recently? Interest rates have gone up a lot. That means their payments that started off really low are now very high. So what was once, let's just say $2,000 a month is now $4,000 a month. If it were me in that situation, if they don't have any immediate plans for the land to make any money, and they don't have the income to support that payment, sell, get out of it, take the loss, do whatever they can, call it a very expensive lesson, pay off that HELOC and walk away from it and never do that again. Let's see what Dave says.
Why did you borrow $50 more than the land was worth to buy the land when the house was paid for?
That was like a business expense.
I'm sorry, a business expense? What do you mean?
We have a handyman service, and the truck that we used died, and so we did use it for that.
So they're using really the house to fund these things that they really shouldn't be doing, okay? They can't afford it. That's what an emergency fund is for. Sure, if it's between that and just being out of luck, I mean, it's better to probably do that than nothing else to fall back on. Doesn't make it right, though. And sometimes, too, with HELOCs, they make it very tricky. Sometimes you could just roll the interest back into the HELOC. So let's say your interest is $2,000 a month. You could just say, I'm not going to pay it. I'll take the cash instead. And just put that on the HELOC. It's like saying, I have a credit card, but you could just put the interest back on the credit card so you don't have to pay it. And then the credit card balance just grows month after month after month. That's what some people also do with HELOCs.
Your business is not making enough money to justify a $50,000 truck. You know how I know that? Because you didn't have $50,000.
Yes, we did.
Why did you borrow money then?
If we have no tax deductions, then we're paying more and more and more and more in taxes.
Do you not know how a tax deduction works? You don't go in debt to create a tax deduction. That's trading $1 for a quarter.
Yeah, it's wild how people think of it like that. Like, I want the tax deduction. It's wild to me, too, that some people look at, like, rich people, let's just say, okay? And they see rich people donating. And they just think,
oh, they're just doing it because they get a tax write-off. If they didn't get the tax write-off, they wouldn't be donating the money.
Well, here's how it really works, okay? Let's just say that a rich person has $100,000 of income and all of it is taxed at 50%. If that rich person saves all the money of that, they're going to have $50,000 left over in their pocket, okay? But if a rich person donates the $100,000, they get a $100,000 write-off. How much does that save them? $50,000, okay? So at the end of the day, they would have more money left over if they just didn't donate the money than if they donated it. A donation really only just saves them in their tax bracket, but it wouldn't save them more than they would be able to keep just not donating the money, if that makes sense.
The kids are going to be much better off to build themselves a self-sustaining life without mommy and daddy doing it.
Well, there's a certain amount of pressure that they're placing on the kids. When you say, hey, I bought this tract of land, then there's also this, okay, I guess
family
that's
compound.
What we got to do,
Yeah, that's a great point, especially when they take out a HELOC. The poor families mortgaged the house to hope their kids move nearby. And imagine the kids don't want to do that, but here's mom and dad doing what mom and dad does. That's bad.
Mom, we got an offer to make $500,000 a year more in Seattle, so we are leaving Charlotte. Guess what you sell that house to? Who? A stranger.
Yeah.
In the family compound.
And how much
some of those
guilt will
strangers
people
are
feel?
strange.
All they have to do really to solve that problem is that they own the compound. And then whoever lives there pays them rent. That way, if there is a divorce or anything happens or someone needs to relocate, well, there you go. Now you can rent it out. You still retain ownership of it.
Take the $50,000 from your business that you had to buy the truck with and pay down the home equity loan so that when the land sells, it pays off the rest of it and put the land on the market.
I don't think Mama's going to do that.
I don't think she's going to do it either, but it's the right thing to do.
It is.
So let me know what you guys think down below in the comments section. Would be really interested to get your thoughts on both of these situations. Also, feel free to add me on Snapchat and Instagram. And don't forget that you can get some free stocks down below in the description when you make a deposit using my paid affiliate link. Let me know which stocks you get and how much you get, because it could be worth all the way up to a few grand. So enjoy. Thank you so much for watching, and until next time.